Welcome to today's event on private debt, hosted by CFA Society Chicago's Education Seminars Advisory Group. This is the third part of our capital markets series. The replay of the first two parts of the series are available on the Society's website and YouTube channel, and recaps are available on the Society's blog. Information on upcoming events can be found on the Society's website at www.cfachicago.org. All mics for attendees will automatically be muted during the event. If you have a question for our panel, please use the Q&A feature. This event is being recorded. Today's discussion will be moderated by Christian Barron. Christian is currently a Senior Business Development Associate with LQD Business Finance, a Chicago-based, tech-enabled private debt fund. Joining Christian for today's discussion are Chris Brown, Managing Principal at Allstate Investments, Phil Kane, founder of Rush Street Capital, and Zia Uden, Partner, Managing Director, and Portfolio Manager of Private Credit at Monroe Capital. I will now turn it over to our moderator, Christian.
Hello, everyone. Thanks again for joining us today. As you may know, we are hosting our third Capital Market Series panel in regards to private debt. Chicago is a big center for the private debt scene, and ultimately we would like to shed some light on the industry and the asset class as a whole. Before we kind of dig into the weeds here, we'll let our panelists and myself introduce ourselves. First, I'm with LQD Business Finance. LQD is a tech-enabled private credit fund. We lend anywhere from $500K to $10 million to small and medium-sized enterprises, both in an ABL fashion. We have two growth strategies, one of which is origination, deal by deal, loan by loan, and the other way we plan on growing is by engaging in an M&A strategy, acquiring other spec-in and ABL lenders out there. With that, I'll turn it over to Phil Kane to introduce himself at Rush Street Capital, and we can go from there.
Thanks, Christian. Phil Kane, I'm the founder of Rush Street Capital. We're a middle market investment bank headquartered in Chicago. We deal with a lot of distressed and restructuring transactions and active in the private credit markets. So happy to be here.
Go ahead.
Sure.
Chris, yeah.
Thanks. I'm Chris Brown. I'm with the investment department at Allstate in Chicago, obviously Allstate Insurance Company. There's approximately 200 professionals within Allstate Investments managing almost exclusively Allstate's capital. I'm in what we call the opportunistic group, which is on the private side of the wall within Allstate. You can think of us, we're kind of between. We have a sister group that's private equity and another sister group that's kind of traditional leverage lending. So my group, the opportunistic group, is will typically take on situations that are a little bit outside the realm of call it a traditional bank, looking for higher return, but also keen for downside protection. In our portfolio, just a couple of examples. We've got portfolios of single-family homes for rent, SFRs. We've got some kind of somewhat mezz deals with some with warrants. We've got a portfolio of music royalties that we actually own, which we like. Feel it's uncorrelated. Finally, one of our investments is a platform company called CIT Northbridge that some people might be aware of, partnering with CIT Bank to make, let's call it, higher yielding asset-based loans. Happy to be part of the panel.
Great, Chris, thank you for that. So my name is Zia Uden. I'm a partner at Monroe Capital, headquartered out of Chicago. Firm was founded in approximately 2004. We manage a little bit north of $9 billion in essentially three areas. We have a private credit book, which is what I manage. We have close to 15 funds, single manage accounts from very large LPs across the globe, as well as commingled funds and a couple SBIC funds. We also have a public vehicle, trades on the NASDAQ, and an opportunistic fund. And then we have a CLO business, which is about $3 billion of our 9. And so I manage our private credit side. We have loans predominantly to lower middle market companies. We have about 500 companies in our portfolio across the platform. On the private credit side, direct lending side, it's close to a little bit north of 200 companies, all various different industries, typically lower middle market. So sub 350 million in revenue, 35 million EBITDA-ish.
Thanks so much, Leah, Chris, and Phil for participating. So we'll kind of get into our first question here, which will be for Zia. If you'd kind of elaborate on as to what was the premise of the founding of Monroe and what was the niche or need that you guys saw to fill in the capital markets within private debt, that'd be greatly appreciated.
Yeah, no worries. So Monroe, as I mentioned, was founded in 2004. So we've been doing this for 17 plus years. A couple of the founders actually were working together prior to Monroe. So we've been doing this a long time. What's funny is 10, 15 years ago, private debt or private credit was really a very misunderstood asset class, right? When we talk to limited partners, they would say, hey, wait a minute, where do I really fit you? You're kind of private equity, you have closed-end funds, longer terms, but you're not liquid credit and you're not mezz, so they had a very hard time understanding it. Obviously, things have changed significantly. I think the desire for current yield has created this private credit asset class significantly, especially post-GFC. So the lower middle market direct lending has been around for a very, very long time. It's gained a lot of traction, I would say, post-GFC. So what we've been doing for 17 plus years is focused on senior secured direct lending, enterprise cash flow. Most of the time, 90% of the time, we're the only lender in the deal, and we have covenants. We source the deals ourselves. We originate, underwrite, monitor the companies. And typically, these are companies 25 years old with EBITDA 30, 35 million. To specifically answer, Christian, your question, the U.S. middle market has about 200,000 companies in it, 10 million to a billion in revenue. And that's the market we play in. That market is very inefficient. So even us, which has 6 offices across the country, we look at 2,000 transactions a year out of that 200,000, and we do 40 or 50 of them a year. So what we like about the space is the inefficiency. We get paid to roll up our sleeves and to dig in. And that is an active strategy. It is not really a beta strategy or a passive strategy. There is some manager expertise, and that's something that we felt we can generate some alpha and differentiate ourselves, which is why we started doing what we did.
Thank you so much. And then with that, the kind of next question will be for Chris here. Could you kind of elaborate as to what is junior mezz lending and the different investment structures and types that you are able to underwrite to?
Sure. So I guess, very specifically, what's junior lending is providing some type of capital in some type of a structure below, a senior lender, typically a bank or someone like Monroe or others that have a first lien. So, you're talking about kind of what I refer to as tweener capital, meaning you're below a senior level that has a first lien, but you're above some type of an equity or maybe other preferred equity or even a junior layer below you. So, kind of the mezzanine is literally in between, 2 other spaces. So for us, what we're really keen on is, the nirvana is you can get debt-like protections and equity-like upside. I mean, plenty of people are trying to do that. But so what we really try to do for us is kind of highly structured transactions. So for example, there's a deal that we're excited about. We closed this summer that it's a growth company that had raised a lot of capital, but was still burning cash. and we were able to provide junior capital, which was the company was either going to raise equity and dilute themselves, and they were going to raise it at a kind of a lesser valuation because they were somewhat COVID affected, not dramatically, but somewhat. So they didn't want to do, as they call, a down round of equity, but they needed more capital, and they hadn't kind of grown to the point that they were able to attract kind of traditional bank financing. So we put in a highly structured piece of paper. We got a second lien, so we stand above unsecureds, and there's actually a convertibility piece, so that allows us to capture equity upside. So that's an example of junior capital, and it's pretty expensive, kind of mid-teens to 20% kind of expected return. But the company was happy because that's a lot cheaper than raising additional equity in terms of that dilution.
Thank you so much. And then with the last question will be to Phil Kane. As you elaborated earlier, Rush Street Capital is a debt advisory investment bank. If you could kind of elaborate on to what your process is, like how you facilitate the process of raising debt capital for different borrowers, and then we can kind of go from there.
Sure. Yeah, sure. I think what we find, really piggybacking on what Zia and Chris had said, the debt markets, especially in the middle market, not only are they inefficient, they've changed dramatically in the last 20 years. Really, and you alluded to it, Christian, Chicago plays a central role in that. Really, the mezzanine debt industry really started and is centered in Chicago and New York. But it's changed dramatically. So I think what we find often with our private equity clients, they may have been in the private equity world for 20, 25, 30 years, but there's a lot of new types of lenders that they still maybe don't have any direct experience with. They maybe have heard of them, maybe they've even met with them a few times, but they've never actually borrowed money from them or closed a deal. And so there's a lot of nuances, and that's really where we can help to apply the right structure, the right type of lender with the right type of deal. And then lenders go through changes, but also companies go through changes, and maybe they're in a different evolution in their company's life cycle. And so we will run a process and try to match up the right structure with the right asset class, the right types of lenders.
Mm-hmm. And then could you also elaborate as to how a bank loan financing solution differs from a private debt financing solution? Yeah,
sure. So that, just in terms of, when I started my career, the world of non-bank financing was much smaller than it is today. It's just grown exponentially in the last 25 years. And there's all types of different types of loans. They kind of get all lumped into non-bank or shadow banking or all these terms, but it's hundreds and hundreds of different firms across the landscape, and they do everything from asset-based lending to cash flow lending. They do there's mezzanine financing. There's just dozens of different types of lenders. Zia, at Monroe, just look what Monroe has built in the last 17 years, and they continue to evolve. Look at what Chris has built. He's part of an insurance company. There's a lot more insurance and investors going direct to lending. There's now private equity firms. The lines have been blurred so much. There's private equity firms that really act as lenders in a lot of transactions and invest directly as lenders. So all that it's great, but it's also problematic because it's really confusing. And to the end borrower, to a private equity owned company, they just need to borrow money. And it's really confusing. They've got all these different options, and often they don't know who to call. And a lot of times when we get involved, we almost know right away they're talking to the wrong people. just because of the deal. But they're talking to maybe somebody they're used to talking to, and it's just a bad fit. So, and often today, banks are limited. The other big thing that people may or may not realize is all of the changes in regulations that have happened to banks. Dodd-Frank was not a minor event in the world of banking. It was a huge event, and it dramatically changed what banks can do. And really, by design, the regulators were trying to drive what they perceived as riskier types of loans off the balance sheets of regulated banks onto firms that could better handle that risk, at least in their opinion. And so that's been a huge sea change that's happened in the last decade as a result of the great financial crisis and increased regulations.
Hey, Christian, let me just interject, Phil, to picking up on that point. We've actually just within the last couple of weeks been spending time with some buyers of non-performing loans and other loan portfolios out of banks, just like you're talking about, that have been pushed out due to various regulatory or just onerous capital requirements. So obviously there's a huge industry out there of buying all kinds of different consumer, residential, and other loans that are being pushed out of banks right now.
Yep, and we can definitely dig into that a little bit later. With that being said, I would like to actually flip the next question over to Zia as to, during the 2008 financial crisis, how was your firm able to benefit or grow or capitalize on the opportunity that banks were being kind of restricted to lend and ultimately allowing for more opportunity?
Right. So, the benefit for us in 07, 08, 09 time period, if you look at our returns, we generated the highest returns during that period. And why is that? As most folks mostly know, when you have capital, when you have dry powder, in periods of disruption, you can generate a premium return, a risk-adjusted return. So COVID-19, and I'm sure we'll talk about it in a few minutes, is very similar. I think the U.S. is headed for a long expansion once they have the recovery, but the recovery is going to take time. And so I see a lot of similarities. Now, the 07, 08, 09 crisis was predicated more on bank lending and banks not lending. We were fortunate. We had locked up pools of capital. We had very good underwriting. Our portfolio held up very, very well. And for us, it's a very thematic investing process. We look at the industries, we try to pick the best players out of those industries, and you have to underwrite that at a conservative loan to value. And if you do your job, then you're okay. And so we knew that if we hunkered down, worked on the portfolio, made sure our returns were good coming out of the crisis, that would be the big differentiator. And sure enough, that's been proven true. And I think in the next 2, 3, 4 years, vintages, you're going to see that play out again.
Mm-hmm. And with that being said, why don't we kind of talk about into your underwriting standards as to how you're able to get comfortable, whether it be extending 3 times leverage to a company or 6 or 7 turns. How are you able to assess the risk associated with those cash flows with the cash flow lender?
Yeah, it's a great question. So everything we do is bespoke. So there is no cookie cutter. And so different industries trade at different multiples. Software trades differently than healthcare, that trades differently than retailer or something else. So the absolute level of leverage is a component, but what we are trying to do is figure out what is the true enterprise value of the business. And these are private companies, they're smaller end. So you don't find the stock prices in the Wall Street Journal. You can't look them up. Part of it is art, part of it is science. So how do you come up with the enterprise value and then figure out, wait a minute, I want to be 50%, 40% of the value of that company as a loan. And that is a combination of underwriting. We look at public comps, private comps. We talk to distressed investment bankers. There's a whole secret sauce where we come up with we believe the enterprise value of the business. Part of the inefficiency in the market is if you talk to somebody buying an asset, they'll say, well, it's worth what I'm paying for it. That's true in today's environment. But what we try to do is look at, in a normalized environment, over the long term, what do these assets trade at? And that is the anchor point in which we loan money. So how do we get comfortable at a 3 times, 4 times? There are obviously natural governors. So a company has to be able to service their debt service. So even if a company's trading at 20 times and I wanted to be 50% loan to value, they couldn't support 10 times leverage on that deal because there's not enough cash flow. So there is some real fixed charge constraints that people have to deal with. But ultimately, what we're looking for are strong industries, defensible business models. And if those industries or those companies trade at 8 times, then we're going to try to be 3.5, 4 times. If it trades at 9 times, we'll try to be at 4, 4.5 times. On our overall portfolio, we are sub 4.5 times leverage on our deals, which on a blended basis means that if you're under 50% loan to value, these things trade north of 9, 10 times for us. And so again, it's a little bit of insight on how we look at things, but everything is very specific on the situation that we're looking at.
And digging a little bit into deeper about that, Zia, how are you able to assess whether the company is going to continue paying its debt? Do you look into recurring cash flows at all?
Yeah.
Do you look into the cost structure, if it's fixed or variable?
Right.
What are some of the analytics you do into those cash flows, the cash flow?
Yeah. So yes, yes, and yes. So Monroe is not specialists in distressed investing. We are not looking at the hockey stick. We're not trying to figure out has problems passed. So what we rely on is historical cash flow. And as most folks know, EBITDA is generally the metric for cash flow. The problem with EBITDA in today's environment is there's all kinds of adjustments. And even in today's environment, now you hear about EBITDAC. EBITDAC is EBITDA, but if COVID didn't happen. So there's a lot of noise in understanding what the definition of EBITDA is. It sounds simplistic, but when you look at a document and people and the lawyers define EBITDA, some of the larger players, the upper end of the market, the EBITDA definition is like 3 pages long. It adds all kinds of add backs and run rates and synergy benefits that they want to get credit for. We have a very different approach. Cash flow pays back company. It pays back loans, and that's what you need to rely on when you're loaning money to a company. There is a segment that I'm sure Phil can talk about on asset-based lending, or Chris, but what we are focused on is enterprise cash flow lending. So we look at historical cash flows, we look at the model going forward, and we synthesize that. We figure out where we can pull levers in case things go wrong, and how much flexibility the business model has. And that is all part of the underwriting process.
Mm-hmm. And then why don't we flip it over and give a little bit of brief intro on the ABL side. How does ABL lending differ? This question is directed towards Phil. How does it differ compared to enterprise value lending or cash flow lending? And we can kind of go from there.
Yeah, sure. Well, basically, just as he has started to allude to it, the focus with asset-based lending is much more on the collateral that the business has, and so it doesn't fit for all types of businesses. For industrial manufacturing companies, it's usually a good solution, and banks can often have asset-based lending departments. They can focus on that. But the big difference is, yeah, it's going to be focused much more on the balance sheet as opposed to the income statement. Cash flow lenders are going to be laser focused on the income statement and levering the company properly and the recurring cash flows. Asset-based lenders are going to be as focused, if not more focused, on the balance sheet and the collateral pools. So equipment, manufacturing equipment, accounts receivable, inventory, that kind of thing. The big difference is, though, that you see in the market is because of that change in difference in focus, the lenders are going to be focused on entirely different things, during the underwriting phase, during the due diligence and underwriting. An asset, a cash flow lender like Monroe is going to almost always require some type of third-party accounting report, a quality of earnings report to really verify those cash flows. An asset-based lender, for all intents and purposes, could care less about that. They're going to be much more focused on the nature of the collateral. Just because you say there's 10 million of receivables, they're going to go in with their own investigation of that, their own field examination, and that's really going to be the focus during the underwriting and due diligence. And because of that, it changes everything. It changes the time frames involved. It changes what the company's responsibilities are. But they're all focused on getting those collateral values to determine how much they can lend the company. And the faster they can do that, the better. So
I would just add to that, Phil, in terms of that, asset-based lending, there's frequent field exams or appraisals, to refresh that, to refresh the values of those, whatever the collateral is that's being lent against. And that can be kind of particularly like, in COVID, some of those appraisals came back quite a bit different than they were, 3 or 6 months prior. But then, a lot of the kind of secret sauce for ABL folks is to kind of structure things such that when that cushion starts to erode and they get closer to kind of the edge of their value being covered, that they're quickly back at the table and are able to somehow kind of right size the ratio of kind of asset value to the loan value.
Yeah, but I would say, just to add to that real quick, it all comes down to a choice, right? I mean, it's like any problem. There's never a perfect solution. There's just options. And with a borrower, the private equity company, why would they choose asset-based lending versus cash lending? Well, it just depends on what's important to them. In many cases, if the assets are good, if the reporting is good and the collateral is good, they can close faster because they don't have to go through a complicated quality of earnings process. And there's a robust market of non-bank asset-based lenders that often close deals in 30 to 60 days. Because if you can verify the collateral and get the numbers quickly, they don't care as much about the cash flow. Now, but that doesn't always work. And so at the end of the day, it's really just about maximizing the borrowing capacity for that borrower. And then, Zia started to hit on one of my favorite topics. People like to put a one-size-fit-all solution on everything, and that's just silly. With certain companies, Zia mentioned their portfolio. They see, they do deals at 4 times leverage, 4.5 times. Certain companies, you would look at the history of that company and say that's totally appropriate. Other companies, you'd say, boy, that's almost lowly levered. But another company, you might look and in that particular industry, you might think, well, you'd be crazy to put that much leverage on the company. I don't care what the assets are and what the collateral is. So it's really just about finding the right fit for the particular company. Some companies just fit well in an asset-based bucket. They can, maximize their borrowing capacity and get a much lower cost of capital and do it quickly. But other companies, asset-light businesses, which of course we see much more in the last couple of decades, it just isn't a good fit.
And I'll just mention, Phil highlighted it, but for the folks that are not as familiar with lending, asset-based lending invariably most of the time is cheaper. So if Monroe and an asset-based lender is sitting at the table, one of us is probably at the wrong meeting, because if a business can get an ABL deal done, it is because you have hard collateral, it is typically cheaper, and people will go down that route. Flexibility is an important thing, but for sure there is a price delta there.
Yeah.
And Chris, I thought that this would be a good point for you to kind of elaborate more so on your tweener capital. You had mentioned a transaction in which you provided growth capital financing for a company that was a high growth company, but there was a senior lender involved there. I would imagine that senior lender was an ABL lender that was a bank. I'm not sure, wasn't there, but thought that you might be able to provide some color as to how you were able to extend the leverage beyond the bank's ability to extend leverage, and like what were you underwriting to differently than the bank was underwriting, or the ABL lender?
Yeah, sure. No, Interesting question. You know, in this case, and there's so many factors, but and it was kind of the senior provider here is an expensive senior provider. It's not an ABL, you know, L plus 175 kind of provider. Number one, because the assets are a little harder to value. But we were a couple things. One, our attachment point versus the enterprise value we felt was very appropriate, like 20%, meaning the company had an equity raise the prior year at a level, and we were lending at about 20% of that. Which and there's, you know, other folks that do kind of what's called venture lending, or in other names, and I think that's kind of the 15 to 20% of enterprise value is kind of a range that they look at. We also thought that in the case that the company had to liquidate, we weren't sure we'd be covered, but it'd be close. And then we were also able to key to our two structuring items, and tell me if this is too specific, but one, we were able to put in an anti-layering provision in our debt, in our docs, so that we knew the amount of debt that could be ahead of us. They couldn't layer us, meaning they couldn't put in an additional layer of capital in between the senior and us. That was critical. Another point is we put in a minimum cash balance or availability, liquidity covenant set at 1 year's cash burn of the company. And so at the risk of being too specific, it basically, so it would allow us to come back to the table, we felt, a full year before, if the company was struggling, a full year before the company would run out of cash. So the structuring of it, and our slug of capital is a lot bigger than the senior slug. A lot of times it's the opposite, but those structural protections and also our attachment point is what allowed us to get comfortable with the loan.
Mm-hmm. And what was your money being used for? What were the uses of the capital? Like,
there's a fair amount of R&D that goes on with this company, and and for working capital. I mean, the company is actually EBITDA negative right now.
Okay.
So it's funding a cash burn.
Funding the cash burn, and you're expecting them to be able to hit profitability based off of your underwriting, your models.
Yeah, and in some ways, our capital provides a bridge to cash flow positive.
And then you're also underwriting to an equity raise as well to possibly get refinanced out, or what was your what were you underwriting to?
Well, so we can convert if and this is like a high growth company in the kind of electric vehicle space, so super hot company or super hot space, I should say, and we think a super hot company. So we've got a bunch of upside relative to we can convert at a pretty significant discount to a valuation if they go public or were sold. So there'd be a real nice pop, but we're not counting on that. We've got a kind of high single-digit coupon that will, continues to pay, as the company goes.
And is that coupon paying or is it picking?
It's about half and half. It's about half and half, just to make sure everyone. So PIK is paid in kind. So about half of the coupon is paid in cash and half PIK. So it means that the principal balance accrues. Mm-hmm. And that was a hotly negotiated topic.
Hotly negotiated, yeah. Okay. Thank you so much for that. With that being said, this is either for Chris or Zia. A lot of the times you guys invest as the senior lender or the junior lender, but there's also capital beneath you. How do you manage not really the conflict of interest, but the difference of interest between an equity investor versus a senior lender like yourself who just wants to get their capital repaid or so on and so forth? Why don't we have Zia kind of attack this question first?
Yeah, sure. So, what we tell our folks, our underwriters, and you've learned this over the 17 plus years at Monroe that we've been doing this. As a lender, the best you're ever going to do is get your money back and maybe some fees and interest. So generally speaking, time is not your friend. If there's a problem, time isn't going to make it better. And so having early intervention, identifying potential issues is the best way to avoid a problem. Now, for an equity owner, it's the opposite, right? So you have this tension where time is optionality. So equity groups are great. Private equity firms are fantastic. Family-owned businesses that are family-owned are fantastic because they will write a check in case things go poorly or they need capital. So there is a constant, not battle, but tension that you have to understand, where is my high watermark? Because sometimes letting somebody put in money and letting a problem fester even longer is not the right answer. So it takes a lot of discipline. It takes a lot of relationships. It also takes experience. So, when I started this business, I probably looked like Phil. I had a full head of hair and I was smiling all the time. And now this is just scar tissue on me. So a lot of it is just understanding the situation you're in and making sure that you're doing the right decision as the lender, being respectful of the owners of the business, because you do, to your point, have a different, sometimes a divergent outcome depending on the circumstances.
Mm-hmm. And Chris, why don't we kind of talk about, as to why don't we have Zia talk about this first? What are some of the covenants you use to manage the relationship, that dichotomy between your equity investors and your debt investors?
So it's a great question. And this is a big topic in direct lending, and it's become a greater topic over the last 2 or 3 years. So in the most recent 2 or 3 years, you're hearing this notion that good companies don't need covenants. And that to me is almost a laughable statement. That's like saying, you know what, I'm a good driver, I don't need a seatbelt. So covenants are guardrails, and it allows the lender to sit down at the table and talk about issues. It's not necessarily a bad thing that somebody breached a covenant, right? It's an opportunity for the lender to sit down with the ownership group and say, listen, what is happening? Let's understand it. Let's come up with a plan and so on. Without covenants, you don't even know if you have a problem. So you hear a lot of these lenders, and I was on a panel, I don't know, maybe 9 months ago, a year ago, where one of the participants said, listen, our portfolio is doing great. The reason why he thinks it's doing great is because their deals don't have covenants. So there's nothing to bump up against to say that, hey, there's an issue here, but that doesn't mean there isn't one underlying. So there are standard covenants that most direct lenders use, fixed charge, leverage, EBITDA, CapEx. Those are kind of the basic ones, but we go a step beyond that. So as I mentioned earlier, everything we do is bespoke. What we try to do is understand what are the business operational drivers of that business and how do they manifest themselves into EBITDA. Those are things that we want to monitor. Sometimes you can covenant off of them. Other times you just have to monitor them. But having the financial covenants are great, but that's stuff that happened 30 days, 60 days ago. What we're trying to come up with are predictors of where the company is going to be, not today, not 30 days ago, but January, February, as we sit today.
And could you kind of elaborate a little bit more as to how do you monitor the health of the financial of the company? Because as you just alluded to, covenants are subsequent events. So
yeah, so we're a little different than other direct lenders. So people look at us. We have 130 people. We manage, $9+ billion in assets. So they look at us and say, "You guys must be crazy. Why do you have so many people for such relatively few assets?" $9 billion is not small, but it is relative to some of the other players out there. And the answer is exactly what I think you're alluding to. We have a very high touch process. Phil talked about asset-based lending. Our chief risk officer actually came out of asset-based lending. And what I tell LPs and investors is we have an asset-based lending approach to cash flow lending. What does that mean? That means you do deep diligence, heavy monitoring, You know what's happening. You know where your working capital is. If payables are going up and receivables are going down and inventory is going down, where did that cash go? If it didn't go down to pay down debt, it's either in losses or it's in CapEx. So we have to understand those relationships. So for us, we want to make sure that we have a handle on all of that stuff, and that's the stuff that we monitor. So our folks are talking to the companies 2, 3, 4 times a month, and we're not talking to the bank agent. Some of these larger lenders, they have a bank agent that then talks to the sponsor. We have a direct line of communication to the borrower, and we can find and get information real time as to what's happening with the business. How is that ERP system implementation happening? Hey, did you lose a sales guy? Hey, and so there's obviously different companies have different things you focus on, but that's the kind of level of monitoring that you have to do what we do, at least in the lower end of the market, successfully.
Mm-hmm. Thank you. Yeah, and then Chris, you had alluded to covenants earlier in regards to the liquidity covenant that you acquired in your transaction. Is there any other kind of covenants that you might require an opportunistic or special situation?
Yeah, I mean, I love Zia's word being bespoke. So it's every situation really is different. You know, beyond kind of traditional covenants of, you know, fixed charge coverage, leverage, minimum liquidity. I mean, those are kind of some of the, you know, the ABCs of financial covenants. I guess the one thing that I wanted to add, you know, your question about is there a divergence of incentives and alignment between a debt provider and an equity provider. Totally appreciate what Zia was saying in terms of they're very hands-on. Now my group that I'm in, there are 9 of us. So we don't have kind of the, you know, the army of folks, if you will, to be, we try to be hands-on, and in some we are, but our model is a little bit different in that in most of our investments, we're partnering with someone that is an expert in the particular space. Again, I'd mentioned, you know, we've got investments in single family homes for rent. We've got a portfolio of music royalties. I didn't say, but we've got a rail car leasing business, a little bit of oil and gas that we're exiting, aircraft leases. So my point is, it's a very broad spectrum, and with 9 people, we are not. It's difficult to be, you know, a subject matter expert. We are a kind of process and structuring expert, but we're not necessarily a subject matter expert. We try to get there. So a lot of times we're partnering with people who are experts. And then so one of our keys is that those partners, like maybe we're putting in the majority of the capital, but they've got to have skin in the game. And then they're responsible for being, you know, the you know, very much in front of the company, to really be on top of what's going on in terms of whether it's financials or, you know, new contracts or whatever it is. So a little bit different model.
Mm-hmm. So why don't we kind of flip the subject to current events? Next question is for Phil. Where, with COVID having happened, and we're probably much 8 months into this, where do you think we are in the credit cycle, and how do you foresee the credit markets playing out in the near future?
Well, that's a big question.
It sure is. I'm getting my pencil out.
Yeah.
If he could answer that, he'd be a trillionaire.
Yeah, I might be on a different panel. I mean, I would start by saying, you know, I think we'd been predicting, and most, you know, panels like this that I'd been on for the past 5 years had been predicting that the credit cycle had to end, and that we were late in the, you know, stages of the credit cycle. It's been such a unique set of circumstances that has happened this year, and I, you know, this isn't me speaking. I'm reading articles every day about zombie companies in the high yield markets, that basically aren't even producing enough cash flow to, and these are large publicly traded companies. So the same is true. I mean, there's middle market companies right now that are just simply going to have to restructure their balance sheet, and that are maybe in industries that are facing, that are just staring into the abyss, that are facing, extinction or just a completely different industry landscape. So that's all happening. But at the same time, we're also reading articles that the debt markets have basically recovered to the same levels they were at before, pre-COVID. So, and I certainly don't talk to a lot of lenders that are just like, oh, I'm so busy, I don't need any new deals. I don't talk to them. The ones I talk to are like, please send me some deals. So, and that's across the spectrum. But the thing that's different a little bit with this cycle, I think, we strongly believe that we haven't been through an event like this where the regulators have really not put any pressure yet on banks. In fact, the opposite's true. Not only, usually what happens in a crisis is the Fed is pouring money into the monetary system, into the banks, but at the same time, the regulators are telling banks don't lend. Right? They're telling them, get rid of all these, borrowers on your balance sheet, and that's not happening. They're in fact, incenting. They're not incenting banks to put pressure on borrowers that are, for all intents and purposes, everybody knows they're in trouble. That's going to change at some point, and we think that'll really be the catalyst to a lot of distressed opportunities.
Yeah, and then why don't we turn the question to Zia as to how has COVID-19 impacted your business, your portfolio? What kind of went on with at the beginning in March, and how did interest rates play out? You can provide some color on that.
Yeah, sure. So, COVID's a very interesting time. We always underwrite to a recession. Now, COVID's a little different. It's a black swan event, so it affects all different companies, all different industries. Whether we were lucky or very good, I would like to think we were good. Our portfolio has held up very, very, very well. And part of that is a function of what we invested in, how we invested, and the companies we chose. So we made, several years ago, the assumption that cyclical industries probably are not where we want to spend our time. We were big in software, technology, healthcare, business services. So these types of business models that I would classify as non-in-person business models. So our portfolio, surprisingly, at least to some people, but not to us, is performed very, very well. What happened during COVID? COVID, in the end of March, you saw the beginnings of COVID. Stay-at-home orders happened around March 15th. And so a lot of the borrowers, a lot of the PE firms, they thought 07, 08 is happening again, where banks would not lend. So there was a run on revolvers. And people would have a bank line and they would borrow, as much as they could on it in anticipation of, hey, what if the lending market freezes? Of course, that wasn't the case. 2020 is way different than 07, 08. And so what you saw was a spike in revolvers for kind of insurance purposes to make sure they had liquidity. And now we are below pre-COVID levels in terms of utilization there. So, in terms of business models, luckily for us, we had focused on the businesses and the industries that were less impacted. We didn't do anything in travel or leisure or very limited in restaurants or bricks and mortar retail. Those are, to Phil's point, industries that I think will structurally change. Real estate, office real estate, I think that's another one where it's TBD. It's too early to tell where all the chips are going to fall. If we had this panel back in April, I would have said, I would have expected by Q4 of this year to be at 70, 80% back to normal. And I don't think we're there. I think it's now predicated on the vaccine, And people, based on who you talk to, think June to December of next year when that's freely available. And then people have to take it, which is now unbelievably a question that some people may not want to take it. So I think there's still some dust to settle, but in terms of how our companies did and performed, because our software companies were killing it, our business service companies were doing well, our healthcare companies, it was a story of have and the have-nots. There were some companies like dental practices or physical therapy offices, the in-person business model were affected more than, you know, other healthcare, you know, addiction treatment or whatever the case is. They were doing okay. So net, our portfolio did very, very well.
Mm-hmm. And then in regards to kind of tying back to a previous topic we talked about the EBITDA add back,
Yeah.
with coronavirus add back. You just mentioned that you always underwrite to a recession. So are you underwriting to the same recession next year? How do you view those adjustments or those add backs in relation to lost revenues or cash flows to coronavirus? Yeah. Like, what's your thought process on that?
So in some respects, COVID is a great information avenue. And the reason is, before COVID happened, you would have to theorize, how would this company perform in a recession? You could look at 07, 08, but some of that information was dated. Now you know, wait a minute, with the last 5 months, this is what happened. So there's more clarity as to what the downside looks like. Going forward, we do not, Monroe institutionally, and if you haven't figured it out, we're somewhat conservative. So we just don't add back as if, you know, March through November it never happened, and oh, you should add that back because you know what, it'll never happen again. You know, it does happen. So we are utilizing the information we've gathered and using it in our underwriting process. But in some respects, like I said earlier, it is a little bit easier because now I know for sure what has happened during COVID. What we're looking at is what could be the potential impact of a second wave of COVID. And you're seeing a little bit of that now, but that's where we're focused on is, listen, if people can't wear masks and take off their shirts and go to the pool, you know, what's going to happen 3 months from now?
Interesting. Chris, or before we head to the Q&A, or Phil, do you want to add some color on your view of the COVID adjustments as to how you view them and get your arms around them?
Well, I would just say real quick, I mean, it's definitely a real issue. There is a tremendous amount of dry powder in debt funds. So they're hungry for deals. And so good deals are still getting done, and they're going to continue to get done. And they will get creative to look at, yes, a COVID adjustment or a COVID adjusted EBITDA because maybe a plant was shut down for April and May, but that was it. The rest of the year they've been open and actually doing well. So that is definitely the case. Is it going to mean that underwriting standards are changed? I don't think so. I think I have a lot of respect for, you know, people like Zia and Chris and these lenders that have been doing this a long time, and they're all in the same world that we're living in. They're scared right now, just like all of us are, and they have the same amount of uncertainty facing them. So there's pressure to do deals, but I would say that they're still pretty stringent with their underwriting standards and separating good companies from bad companies, good deals from bad deals.
And then going to Q&A, relaying right off the topic, has dry powder grown at all during COVID? And if so, do you find that the lower yield that we find in today's market as of March, with the dry powder and lower yields, is that adding more pressure to lenders to do more deals?
Do you want to? I'll just jump in real quick and say one thing. We definitely heard from lenders, especially I would say the non-bank asset-based lenders, that what they saw in, you know, when there was a rush to liquidity in March, like Zia alluded to, and people drew down their lines of credit, they saw their portfolios being paid down. A lot of their loans did get paid down because of that rush to liquidity. And we've heard that from them pretty regularly this year. And that's another reason why they do have some more dry powder and want to do deals. I'll just say that real quick.
I'd throw in one thing. We're in touch with a lot of distressed debt managers, and those folks have raised a boatload of capital this year. So there's certainly a lot of dry powder out there from that angle.
Yeah, I mean, listen, I would add to what Phil and Chris are saying. There's dry powder, but I heard this as well. I came out of the private equity world. I did private equity for a while. Back 15 years ago, people said there's so much private equity dry powder. How are folks ever going to do deals? The fact of the matter is, if you look at the relative difference between private equity dry powder vis-a-vis private debt dry powder, and you think, hey, if guys are doing deals, it should be 50% debt, 50% equity. So you would think those two amounts are equal, and they're not even close. So in terms of runway for private credit, there's still a lot of runway for dry powder, but a lot of it, if you look at what happened in the M&A market, Q2 and Q3, it was very slow. Why? Because beyond the fact that people were running around trying to find toilet paper, it was the fact that they couldn't price risk. So now you're seeing, the turtle head coming out of the shell, and folks are happening. So yeah, there's still dry powder, but especially in the lower middle market, there are 200,000 companies I mentioned. There's in the aggregate $500 billion of debt in that space. Yeah. We are one of the largest players in the space. We did $3 billion last year, so we're a drop in the bucket. So a lot of the biggest thing to keep in mind, and depending on the segment of the market you're talking about, is a vastly different answer. So upper end of the market is way, way efficient. Lower end, sub kind of 350 million in revenues. It's a different animal.
Yeah. And you alluded to this. Yeah, I think the big thing that we see that has happened and is going to affect 2021 is the mentality of CEOs. When you have a crisis like this and this much uncertainty, it doesn't change the underpinnings of why the middle market industry exists. Yeah. And it's that business owner who's now in his 60s or maybe approaching 70, doesn't really have a succession plan. And I'm telling you, this amount of uncertainty, it just incents them even more to think it's time for me to hang it up.
Listen, you bring up a great point. So for the folks that are listening, there are private equity backed deals, which are called sponsor deals. They are the ones that buy companies. They're professional investors. When liquidity is cheap, they are very active. The non-sponsor deals, the family-owned businesses, they are more counter-cyclical. So they are more value buyers. And so I for sure expect, and if history is any guide, you will see more non-sponsor family-owned businesses for exactly the point that Phil's making. A father is always selling to his son. Somebody's always buying a competitor. We're focused on, unfortunately, in the U.S. today, I would argue the sub kind of 10 million EBITDA companies are the most affected, even though there's $2 trillion of stimulus and, potentially another $2 trillion coming. Some of those are zombies. And if you believe in efficient markets, maybe socially that's not a great answer, but some of those should go away. The social cost is a real cost, but efficient markets should say that some of that should happen. So I do think that, depending on the segment that you're talking about, you're going to see more non-sponsored deals because there is a certain level of business activity, regardless of if you're in a recession, pandemic or not, that still occurs. And when you're talking about the size that we're talking about, U.S. middle market, just for folks that are unaware, if you ranked it in terms of the largest economies in the world, would be like the 6th largest. Behind China and France or whatever, Japan or something like that.
That's going to be a huge factor in 2021. Like, we could give real world examples all day long, but that company that knew they could sell for 6 or 7 times a year or two ago, and they thought, no, I'm going to wait, I'm going to hold out. Now all of a sudden, we're ending 2020. They're going, hey, I'd take 6 times for my business. It's time for me. Yeah, let's do that. That's going to be prevalent in the middle market next year.
Mhm. And it is 5 o'clock. Thank you guys so much for your time. I want to thank both Chris, Zia, and Phil for participating today and for their insights on the private debt asset class, and for all of you who joined us for today's event. As a reminder, the replay of our capital market series events are posted on the Society's website and YouTube channel, and all recaps can be found on the Society's blogs as well. If you have any questions about today's event, please contact the CFA Society Chicago office at info@cfachicago.org. You can also follow us on social media, including LinkedIn and Twitter. We have 2 more capital market series events coming up, which will be in regards to private real estate and private equity. Thank you all so much.
Great. Thank you so much.
Thank you.
Thank you.
Thank you very much.